This is a ratio comparing U.S. large caps to U.S. small caps. All right, decode the jargon for us and tell us why you thought this chart mattered to the team.
Yeah, and this comes to us from Charlie Bello, who's kind of one of the chief investment operators for Creative Planning, which is a nationwide firm, and he puts out some great content. But basically, this is telling you that large caps are overvalued relative to the rest of the market.
What's
right?
a large cap?
So large cap is the bigger companies. These are companies 10 billion or larger in size typically.
Cap referring to capital?
Yeah, okay. Exactly. How big of the valuation of the company. And we haven't had this far of an outreach where it's all large cap that's doing all the leading, since you got to go all the way back to the dot-com bubble when the stocks that led the way. And so that's telling you that there's some imbalance in the system, and typically there's going to be a correction. And if you study history, we like to do, it wasn't really good the next 3 years after 1999, was it? It was the only time in anyone listening's lifetime we had 3 consecutive double-digit loss years on all 3 major indices: the NASDAQ, the Dow Jones, and the S&P. All 3 had double-digit losses 3 consecutive years. The last time a chart like this was printed.
So what do we do, or what should policymakers do, or are we just at the mercy of the markets on something like this?
Well, you should have somebody who's proactive in their approach.
Or
so
what
your
should I
asset
do
allocation,
as an investor is what I should really be asking.
Well, you're going to be covered
Especially as
because
a
our
retiree.
portfolios here are automatically going to be reallocating and taking risk off the table when we see things like this. But so for our listening audience, they should basically understand is, listen, if you've looked at your stocks, your portfolio, and we have people come in that we call DIYers, do-it-yourselfers, and they own Amazon and Apple and NVIDIA, and they've owned them for the last 5-7 years, Meta, Facebook, et cetera, and think, oh, I'm a genius, they've done well. Well, everything reverts to the mean. It just does. And so at some point we're going to correct, and we've seen that correction already happen in some of the stocks. I mean, NVIDIA just 3 months ago was a $150 stock. It's sitting around, as we're recording this, around $114, $115. That's a pretty severe correction. Well, if that starts to tumble through all the large caps that have led the market over the last 5 or 6 years, you're going to have a reset in value. And if you're in these passive indexes, in fact, we had Tim on earlier, right? Everybody that's investing in that TSP, those are just passive indexes, right? And so those are going to get clobbered like the C fund, because the passive indexes now are so heavily weighted in these large caps. The top 10% of stocks in the S&P 500, or this top 39% of the weighting, is the top 10 stocks. So if those stocks correct 20%, what's going to happen to the entire index?
Oh, it's going down.
Yeah, because, and we'll be in a bear market
because they
most
were
likely
carrying it all along. So if they go down.
Yeah, and so typically what happens then is you get a reset, and then you'd want to be investing in small caps and mid caps and diversify. So it's just about understanding your risk allocation, how to diversify your portfolio so that you understand the risk you're taking. It's one thing if you're 25. It's another if you're 65 and you stepped into retirement 3 weeks ago. How much risk are you taking? How much risk are you comfortable? And I always tell people, if you can't sleep at night, you're probably in the wrong stuff.